Good morning, ladies and gentlemen. It is my great pleasure of today to have the opportunity to address this distinguished gathering of business leaders. My subject of today is the two-speed recovery in Europe and its implication for trade. As we all are aware that the Standard & Poor's threat to cut Italy's credit rating triggered off the substantial decline in worldwide stock market. And it also caused a turbulence in the foreign exchange market. And it is really just the right time for us to look at the economic performance of Europe and its implication for trade. As you can see from here, we know that since the economic crisis or the financial crisis in the year of 2008, that the EU economy declined by 4.2%. In order to buffer the recession, the decrease in the EU's economy, the European government, they spent a lot in order to buff the economic activities so that the economy stabilized a little bit in the year of 2010 and grew by 1.8% last year. And in the first quarter of this year, the EU economy grew by 2.5%. But all it comes at a cost. It comes at a cost that an increasing in government debt. From what we say in the EU, it increased from what we say 74% to 80% last year. Now, I think we should not be surprised for the S&P's threat to cut or downgrade the credit risk of Italy. As you can see here, the debt, the government debt as a percentage of GDP pile up substantially in Europe. Italy is the one that have the highest debt GDP ratio amounting to 116%, and followed by Greece. You can see here that all those big countries are in trouble. And this increase in government debt is not sustainable because of the increasing budget deficit. And you can see here, for example, Greece, its budget deficit for 2009 accounted for around 14% of its GDP, while Portugal increased its ratio is 9%, UK is even higher, 11.5%, and we see all those troubled economy, Greece, Portugal, UK, Ireland, and Spain, really they have their government budget deficit accounting for more than 10% of its GDP, and inevitably, because of economic pressure, that they have to embark upon austerity measures in order to restore the balance of their government budget. Then that changes, or the cut in government expenditure or raise in government income in the coming years, that will cause a lot in terms of economic activities in Europe. We can see that over the year from 2010 to 2015, Greece will cut its government budget amounting to more than 10% of its GDP, while Portugal is 6.6% and Spain by 8.2%. The reducing of government budget is good from the financial management point of view, but in terms of economic activity, particularly in a very slow economic environment, the cutting of government budget will probably will further drag down the economic growth of those economies. But it seems it is something that inevitable. What happened to Italy? Italy initially is rather reluctant to substantially adjust its government budget. Over the coming 5 years, Italy only planned to reduce its government budget less than 2% of its GDP. And it may be too little when we look at the debt ratio of Italy to its GDP may not be sufficient for Italy to restore the balance. Then that is why people have doubt on Italy's credit rating. And we all see here that more and more money will chip in to the troubled EU economy and try to rescue and stabilize the troubled economy in EU. But you still see that those interest rates, for example, for Greece, Portugal, Ireland, and Spain, substantially higher than that of Germany. It implies that the high financial cost and the bailout burden may continue to cast shadows on those troubled economies in Europe. So as we all see, because of the debt crisis, that the exchange rate, the euro's exchange rate against the United States, as well as against the RMB, fluctuates substantially. Sometimes it recovers along with weakened US dollar. But sometimes because of the renewal of the concern of debt, then the exchange rate of euro decrease. And what are the implications for trade? Apart from the exchange risk, a declining of euro exchange rate against the renminbi have significant implications for Hong Kong's exporter, because we produce, most of our manufacturers produce in the mainland China. Renminbi are really appreciating more than 5%, around 5% last year against the US dollar. And then if the euro declined further against the renminbi, it means the renminbi content cost will be rise much higher when we sell to the European market. And apart from the exchange rate problem, we also have to understand that increasingly more and more of our production in the mainland are sourced, their raw material and input in the mainland. It means that the renminbi content in China-made products are increasing. And then the impact of the renminbi appreciation on the cost element will become more and more significant. So that the exchange rate of euro against renminbi will have a more and more impact on the cost factor and the price competitiveness in our European market. And apart from the exchange rate, what we are seeing now, on the one hand, the economy get into trouble again because the financial crisis or the debt crisis, but the price, the consumer price is aging up in Europe. And reluctantly that the ECB really have their first interest rate increase since June 2009, recently in April. So you see that we are very stuck in a difficult situation that on one hand, we face the debt crisis, and on the other hand, we have the pressing inflation, a very slow economic growth, as well as the interest rate really edging up. And what we have seen nowadays about the European economy, some of them are performing quite badly, and some of them are really some sort of recovering. What we see here in the graph here, those countries in the red box are really those countries underperform. Greece really experienced a decrease in its GDP, as well as Romania and Ireland. On the other hand, Italy, Portugal, and Spain only grow very slowly. And the unemployment rate, according to those official numbers, we can see that Spain and also Ireland, Greece, Portugal, they all have very high unemployment rate. Now, we see, if we look at the European economy, we are not all really gloomy. We consider there are some part of the Europe economy performing reasonably well. On the other hand, there's quite a large chunk of European economy really performing badly. For example, those, as we see it, Greece, Portugal, Ireland, Spain, and Italy, either they suffer a recession or grow very slowly in the year of 2010 to 2012. On the other hand, we also expect Germany, Poland, and Sweden, they will grow reasonably well, particularly the large economy. Germany is one of the star performers in the coming years, 2 to 3%. So, in general, we consider the Europe or the EU market split into two basic. One group of the economy recovering steadily, not very fast, but steadily, over 2 to 3% or 4% the best. On the other hand, some are recovering slowly or even dragging on in a recession period, for prolonged recessions. So, I'm not just talking about the macro thing. More important to us is from the trade perspective, from what we try to sell more to the consumer market in Europe. What does it mean to us? In terms of Hong Kong's total export, Europe or the EU only account for 10% of our total export. However, remember that there are quite a lot of outward processing trade between Hong Kong and China. So at the end of the day, more than 20% of our finished products, finished goods export, are indeed shipped to the European market. It accounts for 22.1% of our export of consumer goods, of which more than half of it are exported to those PIGS countries, what I say, Italy, Spain, Greece, Ireland, Portugal, plus UK, France,